Congress passed the One Big Beautiful Bill Act on July 4th, 2025, and with one massive change to the federal gift and estate tax exemption, many people are asking whether estate planning is dead. Some say yes, I say absolutely not, and I'm going to prove it to you in this video. First, what is the change that most people are talking about in the estate planning world? The new tax bill, which many people are referring to as OB3, increased the federal gift and estate tax exemption to $15 million per person. And with the concept of portability, you can effectively double that amount for married couples up to $30 million. This figure is going to take effect as of January 1st of 2026, and it's been made permanent. This is a lifetime exemption. It means that if the total of what you gift during your lifetime and pass at death is less than $15 million per person or $30 million for a married couple, you will not pay any federal gift and estate tax. How big of a change is this? It depends how you look at it. If you view it in the context of the current 2025 exemption, which is $13.99 million or almost $28 million for a married couple, it's not really that big of a change at all. But if you look at it in the context of what would have happened if this bill were not passed, which would have caused the amount to decrease to $5 million adjusted for inflation in 2026, it's absolutely a big deal. But the question still remains, with the exemption figures this high, who really cares? With over 99% of the US population falling under these figures, why does it really matter at all? And does it mean that most people do not need to do any estate planning? And that's what we're going to dive into in the rest of this video. First of all, I'll point out that permanent does not necessarily mean permanent. Another administration could come along and reduce the exemption or wipe it out completely. And another hopefully obvious statement is that estate planning is not just for wealthy people. Most adult individuals should have at the very least a basic plan, including a will, a financial power of attorney, a healthcare directive, and maybe a trust. Okay, next. OB3 has not touched state-level estate and inheritance tax. Where I practice in Pennsylvania, we still have inheritance tax. And there's no flat dollar exemption, which means that with certain limitations, any asset that passes by reason of death is subject to inheritance tax, starting at $1. Now the figures, the rates are much lower than the federal estate tax rate, but it's still something that has to be considered as part of a cohesive and comprehensive estate plan. In fact, the most common estate planning mistake that I see, and it's a big mistake, is a failure to account for this tax when people are planning. It's such a big deal that I created a completely separate video to address that topic alone, and I'm going to link to it in the description below. Now, on to something else that is alive and well. Probably the biggest shift that I've seen in my career is more of a focus on asset protection. OB3 has had seemingly no effect on this aspect of estate planning. Federal estate tax rates may be 40%, but creditors, lawsuits, divorcing spouses can cost much more than that. And that's why asset protection is a huge part of modern estate planning. The general strategy is that instead of leaving assets outright to your spouse or to your children, you put those assets into a trust for their benefit, which, if structured properly, can provide for your loved ones, but also protect the assets from creditors. I would say that the most common perceived threat is divorce, but it could also be nursing home costs, bankruptcy, judgment creditors, things like car accidents, slip and fall claims, things like that. Here's a key point. Asset protection does not mean cutting off your loved ones. A well-structured trust can provide incredible flexibility, letting your spouse or children benefit from the assets while also shielding those assets from creditor risks. It's all about balancing access and protection. So what you worked for stays in your family. Now let's get back to the changes in the tax bill, and we're going to hit a technical point for those who like numbers. The real shift that will be triggered by the passage of OB3 is toward income tax planning, starting with the standard deduction. OB3 makes permanent the higher standard deduction that was initially increased under the 2017 Tax Cuts and Jobs Act. The result is that fewer people itemize their deductions on their personal income tax return. According to the Tax Policy Center, roughly 90% of Americans claim the standard deduction, which means that most taxpayers no longer itemize deductions. Another important piece of OB3 is the increased state and local tax deduction, which went from $10,000 to $40,000 and will stay this high until 2030. So for those who are looking to take advantage of the higher SALT cap, we're likely going to see the use of non-grantor trusts, which allow taxpayers to stack the SALT deduction. Now, this is a much more advanced planning technique, so I don't want to spend time dissecting it, but it will very likely become a focus for estate planning over the next 5 years. Now, while we're on the topic of income tax planning, one of my favorite areas to help clients is planning for the income tax impact of retirement accounts, of inherited retirement accounts. And this will not change as a result of the passage of OB3, but was majorly impacted by the Secure Act. Final regulations of the Secure Act were released in late 2024, and we're really only starting to see how the estate planning world is leveraging these concepts to help clients do some creative tax planning. The key here is understanding progressive income tax rates and the impact of the Secure Act. So here's the big takeaway. If you have multiple beneficiaries who fall into very different marginal tax brackets under our progressive income tax structure, how you divide your retirement account can make a huge difference. By leaving potentially a larger share of the IRA to lower income beneficiaries, perhaps the more favored eligible designated beneficiary, using the parlance of the Secure Act, and then using other assets to equalize distributions for the high income beneficiary, you can accomplish huge tax savings. Imagine the difference between paying 37% versus maybe 10 or 22%, and consider that some beneficiaries are eligible to stretch out the distributions over their life expectancy, whereas others are required to take all of that money out in a 10-year period. Now, there's a lot of nuance here, but for folks with larger IRAs and a diverse group of beneficiaries, this is absolutely something to consider. I've run the numbers on some of these plans, and without exaggerating, this can easily result in tens of thousands, and in some cases, hundreds of thousands of dollars in tax savings on those more sizable retirement accounts. It's a perfect example of why smart income tax planning in your estate planning can have an enormous payoff. So, is estate planning alive and well? I would say so. Did OB3 cause the death of estate planning? Absolutely not. High exemptions do not protect your loved ones from creditors, lawsuits, or long-term care costs. Pennsylvania inheritance tax still applies from $1, and smart trust and income tax planning can reduce income taxes for you and your loved ones and can save you a lot of money. I hope that you found this video helpful, and I'll see you again next time.